Welcome to KBRA Podcasts, where we cover topical research discussions, industry commentary, and more. Stay tuned for insight from our knowledgeable team members.
Hello, welcome European listeners and market participants, and welcome to KBRA's latest European Credit podcast, Conversations in European Credit. I am Gordon Kerr, Head of European Research at KBRA, and today I am joined by Stephen Hughes and Stacy Gross from our CMBS ratings team here at KBRA. Today, we will be covering the topic of commercial real estate here in Europe, where we will discuss the impact of recent rate rises and how that may feed into the commercial real estate market, in particular in relation to CMBS. You can find our latest reports on the topic and related information on kbra.com, where we regularly comment on everything from commercial real estate to consumer lending. At KBRA, we actively monitor the markets and keep you updated. The latest development has been the rapid rise in interest rates as central banks look to curb the surging levels of inflation. Rising interest rates can have an impact on real estate, both residential and commercial, as they generally require leverage in order to obtain ownership. Rates can impact commercial real estate market in several ways, and the overall direction and magnitude is heavily linked to broader economic conditions. In a recessionary environment, like is predicted to be experienced soon, if not already, higher rates are likely to cause property yields to widen as base rates increase and the risk premiums required by lenders and investors adjust to the levels demanded within the credit markets. Rate rises at some point will begin to put pressure on cash flows as loans are renegotiated and will put pressure on valuations. Here to provide us with their expert opinion based around two research pieces recently put out by KBRA CMBS team exploring how, on the one side, rising interest rates can increase loan to values, potentially leading to loan defaults, and on the other, how it can reduce interest coverage ratios and lead to more expensive extension costs. Ultimately, both appear to make an orderly refinancing more difficult. Stacy, if we start with you, can you take me through how rising rates might impact commercial real estate yields?
Hi, Gordon. Sure. Interest rates are inversely correlated to bond prices. As we have observed interest rates rising over the year, we have also observed rising government bond yields. The 10-year government bond yield is often termed the risk-free rate and used as a starting point for determining a property yield. Property yields will add a risk premium on top of the risk-free rate to account for the higher level of investment risk associated to the property. So property risk premiums often reflect a property use and income profile, among many others.
Thanks, Stacy. And which asset classes would generally have lower property yields?
So assets that are seen as having very reliable cash flows, such as having a long-term investment-grade tenant, may require a small premium and therefore have lower property yields. Generally, we find this across multifamily, industrial, and prime office assets. On the other end of the risk spectrum, assets with more volatile income streams, such as hotels, will warrant a large risk premium since every day you have to worry if your guests will actually turn up.
And how does this impact property values and LTVs or loan-to-value ratios?
So property valuations are calculated using a property's net operating income, which is usually the net rents, over the determined property yield. As I mentioned earlier, in a rising interest rate environment, the property yield will likely go up, and if we assume rents stay flat, it will produce a lower property valuation. Now, if property values are lower, a loan's LTV ratio will increase. CMBS loans generally have LTVs of 65% or below. So if LTVs rise above 65%, it can signal weakening loan performance. And if over 80%, it will heighten default risk. Now, many loans are also structured with LTV covenants. And if a loan breaches its LTV covenants, a cash trap or loan default could occur.
So it sounds like this was the basis for your team's recent LTV research piece.
Yes. In our CMBS LTV stress research piece that we published a few weeks ago, we consider the current rising interest rate environment and the fact that most CMBS loans will be revalued over the next 12 months, with some requiring refinancing. We reviewed 26 European loans across 24 CMBS 2.0 transactions, and we calculated an approximate property yield using the latest reported property valuation and rents. We also added a stress to the yields from 50 up to 300 basis points.
So when you added those stresses, how high did LTVs go in the end? Did they end up breaching the cash sweep triggers or covenants?
So across our sample set of 26 loans, we currently observed 6 loans above 65%, but none were above 80% LTV. And then overall, our review concluded that out of our sample sets, a 100 basis point rise or 1% rise in property yields would equate to 16 loans rising above 65% LTV, of which 2 of those would be above 80%. And a further 200 basis point rise or 2% increase would result in 21 loans, and that's at 21 out of 26, reaching above 65% LTV, of which 13 are above 80%. Now, when comparing LTV stresses versus individual loan covenants, 1/2 or 13 loans will pierce LTV cash trap triggers, and 1 loan defaults just at a 1% rise. Now, the number meaningfully increases when stressed at 200 basis points, where 3/4 reach cash trap triggers and 7 loans default.
So as mentioned earlier, property types can differentiate performance. Did your research show that loans backed by certain property types were more susceptible than others?
Well, all loans in our subset were susceptible to the risks of higher interest rates, but especially those with current higher LTVs and lower cap rates, such as multifamily and industrial properties. They were the most vulnerable to the increases.
Now, can landlords do anything, such as increase rents, to help offset the impact of rising rates?
Yes, well, in theory anyway. You might find that some leases are linked to inflation, and therefore rents will naturally increase year on year. Where that's not the case, there can still be properties with very high occupier demand, in which case the landlord might be able to push up rents to offset the impact of rising yields. But it is unclear how far landlords can really push rents in a recession, particularly when tenants are facing rising costs in other areas. There are also other factors that could impact a property's value to offset a rise in yields, such as increases in occupancy rate and reversionary potential of the assets, as well as the loan sponsor's business plan, which may include property improvements to help drive up rents. But again, it is still unclear whether these things can actually be achieved in a challenging environment, and will take time to see the evidence.
What about structural features such as LTV cash trapping triggers or anything along those lines? I mean, they must help prevent LTVs from rising too far.
Yes, certainly, for those loans that have them. If an LTV trigger is breached, excess cash will still be held back until the LTV falls back, usually through improved property performance or an equity injection.
Very interesting. Stephen, when rates rise, it's not just the valuations that are impacted. Can you take me through how commercial real estate loans are also impacted by rising rates?
Hi, Gordon. Sure. The vast majority of CRE loans, including European CMBS these days, tend to be floating rate. So as such, the lender will usually require the borrower to take out hedging, which can either be via an interest rate swap or, as is more common, through an interest rate cap.
Could you just take a quick minute to explain to any of our listeners unfamiliar with the concept of hedging, in particular with regards to commercial real estate, and how this reduces the risk?
Sure. Let's say the borrower, who is the landlord and owner of the property, receives 1.2 million in rent per annum. Let's assume that they have to pay interest of 1 million, meaning they have an interest coverage ratio, an ICR, of 1.2 times. Now, that interest is made up of a loan margin plus the current reference rate, which in the UK tends to now be SONIA, and in Europe is 3-month Euribor. Although the loan margin will typically stay the same through the term of the loan, the reference rate is floating, so it can move about. If it rises substantially and the loan is unhedged, instead of owing 1 million, our borrower might end up owing 1.5 million, and in which case, with only 1.2 million of rent coming in, there would not be enough cash to service the loan.
Got it. Hence the caps.
Yes, a cap is an instrument that is purchased upfront by the borrower. It has a strike rate, meaning the highest level of interest that the borrower is liable for. Anything over that amount, the seller of the cap pays.
And the lower the strike rate, the more chance of it being breached, and therefore the higher the cost to the borrower, correct?
Correct. Any borrower who wants to purchase a cap now at, let's say, a strike rate of 3% will have to pay substantially more for it than they would have a year ago.
Which can, in the end, ultimately impact refinancing. Does it impact any existing loans in the CMBS world?
It does, because CMBS loans are typically for 5 years, which is made up of an initial 2 to 3 year period, followed by multiple 1-year extension options. There are generally very few financial covenants preventing these extensions, to the extent that most people saw them as automatic. However, one criteria written into most loan agreements is that they still need to be hedged. So when the loan was made, if the borrower went out and got a cap with a strike rate of 1.5%, the loan agreement might stipulate that to extend and therefore prevent a full refinancing, that the borrower has to purchase another cap with the same strike rate. And if SONIA is now way above that rate already and expected to rise further, well...
Sounds very expensive. Is there anything they can do or the servicer can waive the requirement?
Well, some loan agreements were written in a way that allows the borrower to get hedging at a rate that keeps the ICR above a certain level. In these instances, the borrower might be able to purchase a cap with a higher strike rate, meaning it could be slightly more affordable. But in response to the servicer discretion, then the answer is no. As long as it's in primary servicing, then the requirements are clear.
Are borrowers able or willing to pay the extra cost?
So far, yes. And we expect them to keep on doing so because it's likely to be more economical than a full refinance, where higher loan margins may also be incurred. It's also possible that some borrowers may have already locked in hedging all the way out to final loan maturity, in which case it's not such an imminent issue. That notwithstanding, most CMBS borrowers are large, well-capitalized private equity firms, such as Blackstone and Brookfield. Most loans are moderately leveraged, meaning the borrowers have a lot of equity at stake. Also, the flip side to having to purchase a cap at a really low strike rate means that the coverage of these loans tends to be very high, meaning they are throwing off significant cash after paying interest. It's unlikely that the borrowers will want to lose control with all that excess cash going instead to sweep down the loan.
So they should be safe until refinancing at least. With both of these issues, is it more pronounced in the UK compared to the rest of Europe?
Not always from an LTV perspective. Although it's expected that rates in the UK will rise higher in Europe, some yields in Europe got extremely low. In Germany, for instance, prime multifamily was valued at 2.1% yield just 6 months ago. We've also seen prime office yields have already moved up from 2.5% to 3.15%, and prime industrial from 3% to 3.6%. Although the yield shift of 60 to 65 basis points is moderate at the starting point was so low, the corresponding shift in value is large. That said, the yields for urban logistics in Greater London have moved out 85 basis points from a low of 3%. Will probably still move out further. The assets we see in CMBS tend to be in the good secondary range, so not so low yielding, and most CMBS loans are already a couple years old, meaning the closing values were not at the peak of the market.
We think getting extension options for SONIA loans will be more problematic because SONIA is expected to rise more than your eyeball, which means if any UK loans were to become unhedged, we would expect coverage to get quite tight for a number of loans.
Looking forward, it doesn't really feel that either of these issues will go away anytime soon. I know they are just some of the factors that can affect refinancing, but it has to make it more difficult to refinance commercial real estate loans and existing CMBS loans.
Yes, there's no getting away from it. That if loans are exposed to lower coverage and higher LTVs, then it makes loans more difficult to refinance. However, if we compare CMBS 1.0 in the aftermath of the financial crisis, loans are now much better positioned. The starting leverage now is a lot lower. Today's sponsors are stronger. And even when we stressed SONIA and Euribor whilst doing our research, on today's cash flows, none of the loans broke 1x coverage.
We may start seeing revaluations causing a breach of LTV cash trap trigger rather than default covenant, especially on loans at higher LTVs and low cap rates. As Stephen says, due to the current low strike rates of the caps in place, the coverage on a lot of these loans is currently very high, so that could offer some protection to loans before they reach their final loan maturity dates.
As you can see, the current market situation has the potential to cause disruption in the commercial real estate markets. Rising rates have an impact on property valuations and refinancing. The impact is expected to be felt most here in the UK, where rates have risen faster than within the Eurozone. As Stacy and Stephen pointed out, there are implications of these valuation changes and rate rises on commercial real estate loans and the commercial mortgage-backed securities they are held within. The question of the full impact has yet to be answered, but we here at KBRA are actively monitoring the situation. Make sure you are registered on our website, kbra.com, have subscribed to our podcast, and of course, are engaged with our experienced analysts. Thank you very much for listening. We look forward to bringing you more conversations in European credit Stay strong out there as we all navigate through these challenging times.
This concludes our episode. Please continue the conversation on LinkedIn and Twitter at Kroll Bond Rating. We'd also like to remind you that all of our ratings and research reports are available at kbra.com. Lastly, please share any feedback or ideas for future podcast episodes by emailing us at media@kbra.com. We hope to see you next time.